Right now, as we speak, Figma Inc., ticker symbol FIG on the NYSE, is trading at exactly $36.60 USD, down 0.75 cents or 1.99% on the intraday session. If you are watching the charts, you are seeing a sea of red that might make the average retail investor on Robinhood or SoFi Invest panic. But if you zoom out and look at the volume profiles, something entirely different is happening beneath the surface. The market is screaming sell, but the institutional order flow is whispering accumulate. We are witnessing a classic dislocation between price and value, the kind that happens perhaps once or twice in a decade for a company of this caliber. Most people looking at this chart see a falling knife, a busted IPO that has shed nearly 70% of its value since the highs of August 2025. They see the lockup expiration fears, they see the insider selling reports, and they assume the narrative is over. That is the expectation, that Figma was a pandemic darling, a one-trick pony that Adobe tried to buy and failed, and now it is destined to fade into obscurity as AI automates design. That is the lazy take. That is the headline-reading take. The reality is far more uncomfortable for the bears. The reality is that while the stock price has collapsed from its post-IPO euphoria, the underlying business has actually accelerated. We are looking at a company that just reported 38% year-over-year revenue growth in a macroeconomic environment where most SaaS companies are struggling to hit 15%. We are looking at a net dollar retention rate of 131%, meaning their existing customers aren't just staying, they are spending 31% more every single year. When you compare this to Apple stock or even Tesla stock during their growth phases, you realize that Figma is not just a design tool, it is becoming the operating system for the entire product development lifecycle. The market is pricing Figma like it's a declining asset, but the fundamentals are screaming that it is a compounding compounder. Today, we are going to rip apart the bearish thesis, look at the actual numbers from the Q3 2025 earnings report, and explain why this $36 level might be the most important psychological line in the sand for the software sector this year. Let's talk about the price action we are seeing today. At $36.60, we are testing the lows established last week. The selling pressure is coming primarily from retail capitulation and arguably some institutional hedging ahead of the next lockup expiry date. You have to understand the psychology here. When Figma went public in July 2025, the hype was deafening. It opened way above its reference price, surged to over $140, and trapped a lot of tourism investors, people who buy the hype without understanding the business model. Now that the gravity has set in, those tourists are exiting. But look at the volume today. It is lighter than yesterday. The selling is drying up. When you see price dropping on lower volume, it often indicates that the sellers are exhausted. The weak hands are out. Who is left? The long-term accumulators, the funds that use Interactive Brokers or Fidelity Wealth Management accounts to build positions over months, not days. They are likely waiting for this exact flush to deploy capital. The narrative that is driving this stock down is the fear of AI. The expectation is that tools like Midjourney, OpenAI's Sora, and even Canva's Magic Studio will make UI/UX designers obsolete. If designers are obsolete, Figma is obsolete. That is the logic. But let's challenge that. If you actually use Figma, if you use their new Figma Make generative tools, or if you look at their dev mode, you realize that AI is not replacing Figma, it is fueling it. AI lowers the barrier to entry for creation. More people creating means more people needing a collaborative canvas to organize, refine, and ship those creations. Figma is that canvas. They have effectively built the multiplayer browser for the internet's creative layer. Think about it. When you use Schwab Intelligent Portfolios or manage your Fidelity IRAs, the interface you are interacting with was almost certainly designed, prototyped, and handed off to developers inside Figma. 95% of the Fortune 500 companies use this software. That is not a user base that just churns because a new AI image generator came out. That is entrenched infrastructure. We need to discuss the Q3 2025 earnings because the market reaction was completely backwards. Figma posted revenue of $274.2 million for the quarter. That is a massive beat. But the headline number that algorithms picked up on was the GAAP net loss of $1.1 billion. On the surface, that looks catastrophic. But you have to look closer. That loss was almost entirely driven by one-time stock-based compensation expenses related to the IPO vesting triggers. This is a pure accounting artifact. It does not affect cash flow. In fact, their operating cash flow margin was positive 19%. They are generating cash while growing at nearly 40%. Do you know how rare that is? Usually you get growth with cash burn or profits with stagnation. Figma is giving you the rule of 40 on steroids. If you are using SoFi Active Investing or looking at Robinhood fractional shares to build a portfolio, you need to learn to strip out these one-time stock comp charges to see the real earnings power of a business. Adjusted free cash flow was $49 million. They have $1.6 billion in cash on the balance sheet, part of which came from that famous $1 billion breakup fee Adobe paid them. That is a fortress balance sheet. Let's shift gears to the competitive landscape, because this is where the Canva killed Figma narrative falls apart. Canva is an incredible company. It is amazing for social media graphics, for marketing teams, for quick presentations. It is the tool for the amateur creator. And I don't mean that in a derogatory way. I mean the non-technical creator. Figma is for the professional product builder. The difference is precision. You cannot build a banking app interface in Canva. You cannot maintain a complex design system for a global enterprise in Canva. Figma's dev mode, which they launched to bridge the gap between design and code, has been a massive success. It brings developers into the platform. This is crucial. Developers are the most valuable users in the software ecosystem. If you get the developers, you win the platform war. Figma says 30% of their active users are now developers. That is a metric that should make every bear sweat. They are not just a design tool anymore, they are a product development platform. This brings us to the future outlook and the India thesis. Just a few days ago, Figma opened a massive new office in Bangalore. Why does this matter? Because India is the second largest market for developers in the world, soon to be the first. Figma is planting its flag where the future talent is. They are seeing faster adoption of their AI tools in India than anywhere else. This is a long-term play. While Wall Street is obsessing over the next quarter's billings, Figma is securing the next decade's user base. If you are holding Tesla stock, you understand the value of long-term visionary bets. Figma is making those bets. They are expanding into presentations with Figma Slides, directly attacking Google Slides and PowerPoint. They are integrating Figma Weave to bring AI editing into the open canvas. They are building a walled garden that is actually open enough to let everyone in, but sticky enough that no one wants to leave. I want to pause here and ask you a question because this community is smarter than the average analyst. Comment below. Do you think the dev mode feature alone justifies the current valuation, or do you think they need to successfully enter the project management space to justify the multiple? I'm curious how many of you are actually using these tools in your day jobs versus just trading the ticker. Let me know in the comments. Now let's address the elephant in the room, the lockup expiry. We saw reports that insider selling has picked up. The CRO sold shares. Early investors are distributing stock. This is normal. It happens with every major tech IPO. Remember when Facebook, now Meta, came out? It crashed hard in the first year. Remember Uber? It struggled. The market has to digest the supply of shares coming from employees and early VCs who have been waiting 10 years to get liquidity. This creates a technical overhang. It acts like a ceiling on the price. But once that supply is absorbed, the ceiling vanishes. If you are an individual brokerage client looking for an entry, you have to ask yourself, am I buying the stock or am I buying the selling pressure? The selling pressure is temporary. The The stock represents the business. If you believe the business will be bigger in 3 years, the selling pressure is an opportunity, not a warning sign. We also need to talk about the macro environment in late 2025. Interest rates have stabilized, but we aren't back to the zero interest rate policy of 2021. This means valuations matter. Figma trading at roughly 12 to 15 times forward sales after the drop is not cheap by traditional industrial standards, but for a category leader growing at 40% with 90% gross margins, it is reasonable. In fact, compared to some high-flying AI names that have no revenue, it is a steal. You have to compare it to its peers. Look at Datadog. Look at Snowflake in its prime. Look at NVIDIA stock multiples. High quality demands a premium. The mistake investors make is waiting for a cheap valuation on a premium asset. It rarely happens unless the business is broken.